Investing in ETFs is easy, just a couple of clicks with your mobile phone. Investing in ETFs the right way is not so easy. A lot of people from the community talk to us about ETFs. That's why now it was time for us to talk to you. We have been asking you on Instagram what your biggest ETF mistakes have been. Thank you guys that responded to our story for enlightening the community. Every investor makes mistakes, don't get me wrong. It's part of the investing game. You just don't want to repeat your investing mistakes and lose too much money. And that's unfortunately what we see with a lot of people investing in ETFs for the very first time. So let's take a look at the top 10 ETF investing mistakes and how you can avoid them to become a super successful ETF investor. What's up everyone? Welcome to a new investing video from PerFinEx, the #1 English-speaking and independent financial planner in Germany. The stock market came back a little over the past few months, and the German government will most likely increase our tax-free earnings from capital gains from 801 euro a year to 1,000 euro a year. What a time to start investing, huh? And to help you start your investing career in the most successful way possible, you should always remember rule number 1, never lose money. So if you invest in ETFs or plan to do so and don't want to make any investing mistakes and lose money, then pay close attention to these 10 ETF investing mistakes. ETF investing mistake number 1. Said it best, choose the wrong ETFs. This might sound pretty obvious, but let's be honest with each other here. The first thing many people do when thinking about investing in ETFs for the first time is probably Googling best ETFs in 2022. Come on, I know that at least some of you guys are doing this. That's just not how it works. Because the right ETF is not the one that is going up now, and the wrong ETF is not the one that is going down now. But we'll talk about market timing later on. Let's look at this from the thought process that I learned in the German military. First comes the strategy. What are you trying to achieve? Why are you investing in ETFs in the first place? Financial freedom, for example. That's a strategy. After that, we determine the tactic. How do we get there? For financial freedom, we need money to support our living costs. So regular dividends might be a good idea. And after we got our strategy and our tactic, then we choose the right ETF for that strategy and that tactic. Choosing the ETF is step 3, not step 1. ETF mistake number 2, not understanding what you're actually buying. Before you buy an ETF, you should know what you're actually investing in. What's inside the basket? I know it can be tough to figure that out because ETFs have all these funky names and abbreviations, so it can be tough to understand how they really work in detail. To help you out, here are some important distinctions. Is it an index fund? If so, your ETF tracks an index. So if that index goes down, your ETF will go down as well. Is it a long ETF or a short ETF? If it's a short ETF, what I just said is reversed. If the market goes down, your ETF will go up. Is it a bond ETF, an equity ETF, a commodity ETF, a real estate ETF? What the f is your ETF actually investing in? Check the websites of your ETF provider and you will be surprised how transparent ETFs can be. Understand the weighing method. Not all ETFs are the same. Do you have an equal weighted ETF that would look like this? Or a market cap weighted ETF that would invest in the majority of its holdings into the largest companies? A little research will go a long way. Just see these two examples when searching for equity ETFs for the German market. One ETF went up 25% over the last 5 years and another went down 25% over the last 5 years, even though both invest in German equities. ETF investing mistake number 3, the illusion of diversification. We just talked about ETFs and their fancy names. That actually makes it very tough to diversify, as it's very easy to buy ETFs with different names that have the same underlying assets. Let's say you buy 3 super popular ETFs, the Nasdaq 100, S&P 500 and MSCI World, which is super misleading with its name, by the way, all in an equal distribution. You have 3 different ETFs now, but 90% of your money is invested in the US. And if you check the top holdings, you can see that all 3 ETFs invest in the same thing. Congrats, my friend! You invest in 3 different ETFs, they all sound different and have different names and different indices, but when you're looking closely, they are very, very similar. That's why we call it the illusion of diversification. ETF investing mistake number 4, timing the market by trading ETFs. And that's maybe what Vinay means by not investing, because he was waiting for that perfect moment. Don't get me wrong, you can time the market. And if it happens, you guys send us very friendly messages.
I just bought at the perfect time. Suck you and your videos. I'm the best investor in the world.
Well, congrats. All power to you. Or these messages about our community investing.
Axel, the market dropped 20%. You idiot should have sold before the drop.
Yeah? No shit, Sherlock. And how is anybody supposed to know what the market will do tomorrow? The odds are stacked against you when you try to time the market massively. There's a way higher chance that you will get market timing wrong than there is that you'll get it right. The empirical evidence is clear on this one. Check out this study from JP Morgan. If you would have invested $10,000 in 2002 for entire 20 years in the S&P 500, you would have over 60k at the end of 2021. If you try to time the market and miss just the 10 best days, your return is cut in half. And if you miss the best 30 days in that 20-year time frame, which is just 0.4% of all days, you have basically zero return over 20 years. Negative even with inflation. A big reason why I feel people are trying to time the market is ETF investing mistake number 5, hopping from one theme ETF to another. 5G, self-driving cars, 3D printing, COVID vaccine, esports, crypto ETFs. By the way, nobody told us he would become a crypto millionaire in the last few months. I wonder what happened. The next big thing is always the same. As soon as something is hot, a lot of money goes in. The ETF starts outperforming the market for a while. Even more money goes in as people start chasing performance. Stocks get overvalued and go down, your ETF goes down, and you get frustrated with the performance, so you buy into the next trend. It's always the same. Buying high and selling low. The exact opposite of what you should be doing. And this gets worse and worse every year. Last year, we had more than 1,000 different ETFs published, most of them chasing the hottest new trend. This whole trend investing thing is probably part of a bigger ETF investing mistake. Number 6, not understanding risk. What do I mean by that? Well, risk works in 2 ways. You might underestimate risk because of a great run of the stock market. And as soon as the market starts dropping a little, like right now, you panic sell, which is probably the biggest mistake of all. Or you overestimate risk. If you have 10, 20, 30 years to invest, why would you care about day-to-day market fluctuations? Stop tracking your portfolio every day and stop trading ETFs back and forth because you expect immediate returns. Why? Probably because you're emotional. That's ETF investing mistake number 7. Money is an emotional topic for each and every one of us, so it's difficult to not lose your mind. I understand. I actually understand it more than ever after shooting our first episode of Financecouch with the biggest portfolio drop I have ever seen, almost 80% in the minus. Link is in the description if you want to check it out. Really think about things before you press the buy or sell button. Again, just because it's easy buying and selling ETFs doesn't mean that you have to do it. If you can feel that you're getting emotional, take a step back, relax, and when you're cool, calm and collected, Then you can make a decision how to move forward with your investments. ETF investing mistake number 8, not knowing how and when to trade. 2 things. First, always use limit orders that will make you buy or sell an investment above or below a certain price that you can determine for yourself. So you have ultimate control by putting the price into your hands. When you use market orders, you buy or sell your investment at the best possible price right now. That's maybe okay-ish for super liquid ETFs, but you still run the risk that you don't get the price that you wanted. And second, trade during the day and not on open or closing times, as these times have usually higher price swings. Trading during the day when the liquidity is higher will give you a better price, which will give you a better return. And definitely don't trade on the weekends or when the markets are closed. ETF investing mistake number 9, getting caught up in fees like Cashyap M94. Fees are important, I get it, but the TER is certainly not the total expense ratio as the name says. What about the tracking difference? If your index makes 10% and your ETF makes only 9.5% because of the 0.5% tracking difference, isn't that fundamentally a 0.5% fee? You might not believe this, but a more expensive ETF in terms of TER might outperform a cheaper ETF with a better tracking difference. And again, as mentioned in ETF mistake number 1, it comes down to your investment strategy. Congrats if your ETF is 0.05% cheaper, but because your strategy sucks, your whole portfolio is down by 10%. And of course, a market-weighted index fund has a lower TER than an equal-weighted sector ETF. But if that's right for my personal strategy, I would go with a more expensive ETF all day. And lastly, ETF investing mistake number 10, factoring in ETF currencies. If you have an investment account in Germany with Euro as base currency, the currency of the ETF you buy doesn't matter at all. You will have the exact same price and return as either your broker or the ETF provider factors in the exchange rate. It's only cosmetic. Now, what about these USD hedged ETFs? A nice diversified ETF will have different currencies anyway. So as an investor with a long-term investment horizon, I don't think you need to hedge against currency risk. Don't forget, currency exchange rates can not just be a risk, but also a chance. Don't be super German and only think about risks. Take Apple for example. Of course their shares are in US dollar, but they make money all over the world in probably 100 different currencies worldwide. So there's an implicit currency hedge already when you buy the company. Hopefully that list helps you to become a super successful ETF investor. Did we forget any ETF investing mistakes? Which mistakes did you do when investing in ETFs that are not on our list? Let us know in the comments and enlighten the community. See you next week, guys.